Markets mixed today. We have seen another drop in the S&P 500, though, and that's after 2 days of selling in North America. Actually, you can see the Nasdaq and Toronto also losing a bit of altitude today. Okay, we are joined now by an investor who says he is short some of the stalwart sectors in the Canadian market. Patrick Horan, principal at Agilith Capital. Thank you very much for coming on the show, Patrick.
Thanks for having me on.
If I could summarize your playbook, you do think the market is overbought. And this is interesting. You are short some names in the high dividend, telco and utility space.
That's right. I think what's happening right now is, and we're seeing this play out in bond yields across the whole spectrum, is we're putting inflation risk, or in other words, term premium, back into the bond curve. And it's causing a whole shift up in the entire curve. It's simply just a normalization of an economy that really doesn't need fiscal help or monetary help. And with that, we're seeing the reverberations of that play out in equities, and specifically really the defensive bond yielders that were bought in place of very low bond yields. And now that bond yields are higher, they're just not needed. So there is a compression in the multiples of these so-called defensive plays.
Do you think, though, they've already been punished? Quite a few of those pipeline stocks, for example, are way down, but you think there's more pain to come?
I do think there's more pain to come, because I think management teams have been delusional about dividends. I think they've benefited from an interest rate cycle that was very kind to them in terms of their debt. It was very forgiving in terms of the market's view of assets that they bought. Accretion became a multiple increase. That is, when you accrete from earnings that you purchased, you got an improvement in your multiple. I think these are anomalies. They shouldn't have been. These are factors of a central bank system that was completely flawed over the past 10 years. And really what we're seeing right now is just a normalization of that. I do think in some cases of my shorts, I really don't believe they can afford their dividends. I do believe they're going to cut their dividends eventually. I don't think it's going to happen over the next year. But you know, there's an old trader saying that you never want to buy a dividend yield with that's more than a hat size, and that's 6. So anything over 6, you should be looking at your investment as suspect.
Well, that's good. That's old school. The hat traditionally.
Absolutely. I am old school. Look at my hair.
Although some people have had some 7+, though, don't they?
It's true. It's true. I think right now what's happening, though, is you're seeing a complete shift in portfolios.
Okay.
And portfolios, I mean, that's, you know, we just talked about the kind of the bear case, but I think there's a bull case as well. Mm-hmm. There's a lot of stocks out there that have been suppressed in terms of their multiple for years. And I think they're very good companies. And I think they have the opportunity to shine with higher growth rates, mm-hmm. as well as multiple expansion. And specifically, the areas that I would look to are companies that are in the manufacturing side or have fixed asset bases, mm-hmm. That they can lever off of. That's kind of a replacement for high expensive labor, and their costs are historical. So the costs tend not to be inflation indexed. And that's very important. If you can run your revenues at inflation, mm-hmm. You're going to get the improvement from those fixed costs that are historical, and it drops to the bottom line. So I think that's what we're seeing right now is kind of the offset of what's happened over the past 10 years, which is these companies were fine companies. They earned well, they were managed well, they were just ignored. So you know, cyclical values really is what we're advocating to be in.
Let's squeeze in some stock ideas. SNC is one that you bought a while back. You're happy to see the move upward today?
It is a nice move. We think there's a revaluation taking place right now. And engineering services it's a pure service play, which is really where they're trying to slim down and get to. They're not quite there yet. But we could see, 19 or 20 times earnings on the stock. It still gives you another, a lot more upside. I won't put a number up because I don't want people to go crazy over it. But it is a good stock. We're quite confident management has a good handle on things. It's a new management team as well, and they've shot themselves in the foot many times historically. We don't think that'll be the case going forward.
So that's SNC you're talking about there, because I think we slipped up
That's right.
Yeah, a chart of precision by mistake. Gildan, obviously a global leader in T-shirts. Why do you like the look of them?
Yeah, I think they've been, they were a growth darling going back 10, 15 years ago. Some of the realities of that growth multiple had to sink in, and they're not immune to downturns. They're not immune to competition. They are a world leader. They are a low-cost provider. We think management is working through a number of challenges, and some of them were their own doing, but some of them had to do with COVID and understocking and overstocking and trying to catch up to that demand. We think they're just at the tail end of getting through all of these issues. The earnings were fine. Surprisingly, I was expecting bad earnings, but they actually came in well. The guidance was a little on the poor side, but it's really just a mix issue. So we think it's still very cheap when you actually strip out what they have, and we think there are going to be better times ahead. And I think people are going to be looking for companies that are slightly cyclical like this one, that are good management teams that were former growth companies and have more multiple expansion in front of them. And
just finally, very briefly, if you would, Precision Drilling. Why do you think they hold promise?
They are cheap, 4 times EBITDA. We think we're going to see a lot of stability with the oil market. We see the major oil companies have a lot of trepidation and resilience to producing new wells and bringing product online. And with that is going to be unbelievably stable oil prices and upward sloping. And we think that's great for the drillers, which traditionally get the biggest complaint with holding them is that they're incredibly volatile from a fundamental standpoint. We don't think that'll be the case this time. So cheap stocks that outperform is really where you want to be. This company actually had stellar earnings the last quarter. We think that continues for a long, long while. So we're quite optimistic about this company.